Hello again, traders. Dwayne Jabba there from DRFX, Forex and Trading, also known as Daddy Papi, in a Dukascopy Trading Competition for this month of December 2017. Now, I'm going to be taking a look at a recent trade that was made on the Euro Kiwi Dollar currency pair, where I captured a short trading gain of 73 pips as I took advantage of the movement within the range setup of this currency pair on its 4-hour chart. Here you see the consolidation range setup on this time frame of this currency pair, where the market had attempted to start a bullish breakout above resistance, but instead of responding to this bull signal and providing gains in favor of the euro, the market reversed sharply with this bearish engulfing candlestick formation, indicating the start of the movement back inside of the consolidation and at least back toward the support boundary of this consolidation setup. Now, the idea behind false consolidation reversals, which you will see across the currency market and across all time frames, is basically that the market will attempt a breakout at one end of the consolidation, but instead of continuing in this direction in response to the signal, the market will provide a strong reversal signal that would tell us that the market will either head back inside of the consolidation to break out at the other end, or continue to move within the consolidation to then break out either at this opposing end, or attempt once more to start the breakout at the initial boundary where the initial attempt was given by the original signal here. Now, once the signal appears to indicate the start of the reversal, you can trade it in one of two ways. You can either trade this initial signal here and take the ride as the market heads back towards the other side of the boundary, or if the stop loss is too large, or for whatever reason this signal is not appropriate for your type of trading strategy, you can then trade signals that are formed along the way as the market makes its way towards this opposing boundary target. So for example, you can trade in terms of a downtrend. You can trade if the market presents this in the form of double tops, but more than likely you will find evening stars and ABC signals when the market is already moving, and you can take advantage of these signals and trade towards the target. Double tops are probably more common to start the move instead of continuing the move, but this is another example of a signal that can actually start a reversal signal, and you can either trade this initial signal here or trade these signals that are formed along the way as part of the movement towards the opposing boundary. So in the case of this trade setup here, instead of trading this initial signal where the stop loss would have been too large for me, what I did was to wait until the market formed another bearish engulfing candlestick formation, formed this trend line, which allowed me to place a stop loss at a lower area here instead of placing it all the way at the high, and I took the ride as the market made its way back toward the support boundary, where it provided me with a trading gain of 74 pips as part of this reversal signal, as part of this reversal trend here. So this is a very typical example of how we can take advantage of these false breakout reversals that we see every week across the currency market. Once the signals that start the reversal are strong, we can either trade this initial signal, or we can trade signals that are formed along the way as part of the movement towards the opposing boundary of this reversal trend. So until next time, we're going to be taking a look at what other opportunities will present itself either on this currency pair or on other currency pairs where the market provides trading opportunities as part of the movement within consolidation before breakouts actually take place. So until next time, traders, happy trading.